I will send that on the system, and I will also prepare a slide on that as I'm used to doing, so that it's more self-explanatory. It's okay for you? Okay. Right. So, having said that, before moving to real option, I'm going to take 5 minutes more because I took an assumption. I needed to perform the calculation, which is not necessarily justified. I mean that I have said, well, 60% in cash and therefore 40% in shares. But why not 80% in cash and therefore 20% in shares? Or 50-50, I don't know. I didn't want to take 50-50 because when I take 50-50, from a pedagogical point of view, it's not very easy to follow. First point. Second point, I said, well, let's take a 30% premium. But why wouldn't it be 20, 10, or 50%? I mean that now I'm speaking as an investment banker, not as a professor. But when you go and visit a CEO to try to convince him or to convince her to launch a tender offer, to contemplate very positively a M&A deal, you need to present all the possible cases, not only one. You can say, well, it's a central case, maybe. But you think that it's interesting to show 60% paid in cash and 40% paid in shares, and the CEO, who is clever by definition, otherwise wouldn't be the CEO of a listed firm, we have something else in mind. Moreover, I've taken 30% as a controlled premium. And it happened that the CEO may tell you, well, I've already discussed with the target. Sometimes happen. You go and pitch somebody who knows very well the target and was already had discussions either with the target or with one of the main shareholders. And he says, well, we know that it's possible to have a deal if and only if the premium is at least 50%. You are not going to take your calculator and calculate in the room. Okay? No. You need to present a table describing all the possible cases. And I have to tell you that for finance people, the most useful function of Excel is a table. I'm going to tell you why. In fact, in finance, you've probably seen that beyond the course we've had together, we base most of our decisions, we base most of our calculations on forecasts. And by definition, forecasts are not certain. So we take an assumption, and the person you are discussing with, the CEO, the CFO, normally the CEO, may have something else in mind. So the best thing to do, if you want to feel comfortable during the meeting, is to have a table with all the possible cases. And it happened that in important firms, not necessarily listed, but of course, in listed firms, the CEOs are used to seeing investment bankers presenting a sensitivity table. I remember that once for a presentation I did maybe 10, 15 years ago, I had focused on a central case because I was sure that it was the right case. And the guy I had in front of me said, didn't you present a sensitivity table in the appendix? I said, no. Luckily, I had my laptop and I did it during the meeting. So let's do the table to terminate rapidly. So, well, we are going to say that we have a sensitivity where is it? Okay. So sensitivity analysis of the, let's say, 2023 You can do that for every year, but I'm not going to do it during the course. EPS accretion to the offered premium and to the percentage paid in cash, which are the two main financial assumptions, the two main parameters paid in cash. So we're going to say you have here the premium. So the premium, which can be 0%, 10%, and so on. Just a second, because I'm going to reduce slightly the size of the, yes, I have a problem with Société Générale. Okay, now you understand why I'm here. Okay, so anyway, so 10%, I can go to, let's say 50%. We'll stop at 50%, it will be enough. So you can see that you have an interesting range of possibilities regarding the premium. I'm going to center across the selection of cells here, premium. Okay, so I'm going to put everything in italic. I would like to show you that all the figures here have been entered. There is no formula. So I'm going to put it in blue. And I'm going to say here that I'm going to put the percentage paid in cash. And so the percentage paid in cash, I'm going to say 0%, 20%, and so on. And I can go to 100%, which would be a takeover bid. So, of course, everything has been entered. So it's in blue. I'm going to center that. And I need to say to Excel what I want to simulate. And I would like to remind you that we are dealing with 2023. Okay. So having said that, I'm going to say to Excel in this cell, which was intentionally left blank, that I want to simulate what this number, this EPS accretion for 2023 becomes if instead of having a 20% premium and a 60% deal paid in cash, I have a premium ranging from 0 to 50% and the percentage paid in cash ranging from 0 to 100%. It's impossible after 30 years or 31 years of M&A to see this percentage here. I'm going to hide it with a white font. It still exists. If you double click, if you're on a MacBook Air on this cell, or if you type on F2, if you are, as I am, on the PC, you see that it still exists. But I feel so much better if I can't see that. So I am selecting the cells, you see, and I'm going to say that I want a table. So if you had Excel in English, it would be data, what if analysis, table of data. So in line, first line of the table has the premium, and in the central case, the premium is 30%. I said 20%, but I realize now that it's 30%. And in column, you can see the table. In column, you have the percentage paid in cash. And in our central case, the percentage paid in cash has been 60%. So I say okay, and I have the table which is done. So it's not very beautiful. I'm going to put some percentages. I'm going to put one figure after the point. And I would like to tell you that I am 100% sure that my table is correct. Because as you can see, I recognize inside the table our central case. The central case is made of a premium of 30%, premium 30%, And our central case is also based on a percentage paid in cash, which is supposed to be 60%. And where is the 60%? It is here. So when I recognize my central case, there is a huge likelihood that the table is correct. I would like to show you two other points before stopping for tender offers. First point is that if you take any line and if you go from the left to the right, from the left to the right, okay, from the left to the right, you can see that the percentage on any line is decreasing. It's not surprising because you pay more and more. So if you pay more, on the one hand, you pay more interests, which decreases your net income, and you issue a higher number of shares if necessary. So it's less and less accretive and sometimes more and more dilutive. The second point is that if you take any column, the first one, the second one, the last one, and if you go downwards from the top of the table to the bottom of the table, you can see that you pay more and more in cash and that the cost of debt is historically low, not for a very long while, according to me. Okay, if you replace shares issues by payment in cash refinanced by debt, you increase your EPS accretion. And then, of course, we could do many other things, but the two main calculations which are awaited by a CEO are the one I've just done. Now, I would like, before leaving this point and moving to real options, to know whether you have Trump, but other people also, if necessary, other question on that. Does it answer your question? Of course, it will be put in slides. Okay, and of course, I will put the model, as I've already done, on Canva. It's okay now? It's okay? Okay, perfect. So if it's okay, I remind you that I am supposed to deal with real options with you. This is what I'm going to do. So again, we are going to spend a bit more than 2 hours on real options. I could spend 30 hours on real options. To tell you the truth, the real added value in my PhD thesis was focused on real options applied to M&A. Okay, and the person who chaired the jury for my PhD thesis was Alain Chevalier. He's been my professor at ESCP, and I asked him, and he answered yes very kindly. He accepted to be the chairman of the jury of the defense of my PhD thesis. So we could spend a lot of time, but I would just like to explain what it is, the main points, okay, on that front. Normally, I forgot to check, honestly, but if he said to me, can you please deal with real options? I suppose that the answer is yes. You've already heard about financial options. You've already heard about Black-Scholes. Yes or no? You know Black-Scholes? The Black-Scholes formula. Yes or no? If you've never heard of it, I will explain, of course. But I wouldn't like to repeat what's already been explained by other professors. Did you see the Black-Scholes formula? Yes or no? Can you say, type yes or no, or say it directly? Yes, so it's only a refresher. Okay, I do not need to explain what an option is. If you've seen what Black-Scholes, you know what an option is, because it's not necessarily the most basic point. It's not the most basic point, but I'm used to saying 2 points to students at HEC Paris, which is that you probably know that Myron Scholes got the Nobel Prize thanks to the Black-Scholes formula. Fischer-Black should have got, of course, the Nobel Prize with Scholes, but he had died before. This is why only Scholes, but also Robert Merton, who worked on the same topic and who got the same output, the same formula, also received the Nobel Prize in 1997 for their seminal formula, which dates back 1973. So I'm used to saying to students, just in order for them not to be afraid, but I'm very comfortable with you because you've heard about Black-Scholes. It's not as if I was presenting it to you for the first time. I'm only going to use it. I'm used to saying that they've got the Nobel Prize, but they didn't get the Nobel Prize because they found a complex formula. No. You get the Nobel Prize when you establish a formula which is validated by the market. I mean that you get the formula because everybody is using the formula. And everybody is using the formula because it's an easy formula to be used. I'm not going to tell you that. The evidence, the proof is simple. I will send to you if you're interested. The evidence of the Black-Scholes formula, which is on my YouTube channel in English. So you will see it. And it's mathematically presented in a way which is different from the one which was chosen by Black and Scholes. I mean that Black and Scholes proposed in their seminal paper differential calculus, whereas I'm used to preferring integral calculus. But at the end of the day, you get exactly the same. So what I want to say is that the proof is not easy. The use is very easy. It's the first part. So when you speak about options, when you've heard about options with other professors, you were not said, because it was not necessary at that time to say it, that we are dealing with financial options. When we deal with financial options, the underlying asset is listed. Second point, when you deal with financial options, the most important point is that this option can be traded. You can buy the option, you can sell the option, either on an organized market or on an OTC market. But it's possible to buy and to sell. I mean that it is a security. Real options are not securities. The principle of real options consists in solving corporate finance issues thanks to option pricing models. I mean that we can use the Black-Scholes formula, which has been presented to you as a way to value a call, to value a put, which can be listed on an organized market, on many markets in the world. Okay, so it means that the call and the put you've valued thanks to the Black-Scholes formula could be purchased. We are going to use Black-Scholes because we are going to consider that some assets, some situations correspond to options. But the options we are going to take into account, we will see several ones, are not sold on the stock exchange. You can't buy and sell these options. It's only a way to analyze the situation. I'm going to take several examples. We will take as many examples as possible given the time we have. And we are going to start with the most impressive way to use real options, which is relative to equity valuation. It's not the most common way to describe what real options are, but some people consider that they are real options, and it's very interesting to present that. This is what we are going to do from now on. So I need to write down. And I need to open my OneNote file. Okay. So in fact, yesterday and the day before, we dealt with leverage buyouts, and paragraph 3 will be dedicated to real options. So let's do it now. I will remind you what Black-Scholes is in a few minutes when necessary. So 3.1 will be dedicated to the limits of the DCF approach. We didn't deal together with the DCF. We preferred to focus on the DDM for financial institutions. I didn't do any DCF evaluation with you because I know that it's been done in other courses. I need to remind you what it is. We said, I didn't say anything to you on that front, but other professors said that the enterprise value is the sum of the present values of the free cash flows to perpetuity. And the equity value E is enterprise value less D, where D is the net debt, K is the weighted average cost of capital, okay, and FCF is, of course, the free cash flow, you know, which has been said yesterday, after tax EBIT or net operating profit after tax, plus DNAs, less net capex, less change in net working capital. You've also been said that the WACC is the cost of equity times the weight of equity in the financing plus the after-tax cost of debt times the weight of debt in the financing. I'm sure you know that. K, the small k, is the cost of equity. We viewed the cost of equity in the DDM approach in order to value Société Générale. You know that there are several ways to calculate the cost of equity. But investment bankers, financial analysts are used to focusing on the CAPM, risk-free rate, plus the beta times the market risk premium. I know you've seen that. And regarding the beta, you know that it is the covariance of the return of the stock and the return of the market over the variance of the return of the market. I would like to tell you that William Sharpe, who proposed in 1964 this formula, not because he was interested in the cost of equity, but because he was interested in the simplification of the Markowitz model to select a portfolio, also got the Nobel Prize. So I mean that everything is very scientifically done when you look at what I am presenting here. But I have to tell you that you can fine-tune the calculations as you want. I mean that, as you can see, The beta is a ratio between the covariance and the variance. I mean that the beta is based on the statistics between the return of the stock and the return of the market. And you can easily imagine that you can take many assumptions regarding these statistics. I mean that you can say that you have a period for observation. You can say that I take 1 year, 2 years, 5 years, 10 years, 20 years, and so on. And you can take many possible assumptions regarding the periodicity. Just a second. Regarding the periodicity, you can say that I take daily observations, weekly observations. Sorry, I need to put it here. Daily, weekly, quarterly, yearly, and I forgot one. And inside the table, we will have the betas. Let's say that we have here 1.2, 0.8, 0.9, 1.3. We can say that you have here 0.9, 0.7, and so on. So I mean that according to the period of observations, you decide to take into account, according to the periodicity of observations, you decide to take into account, you may have betas, which are different. You do not need to perform any calculation to be convinced by that. I'm going to prove it. Look, I'm going to go on the web and I'm going to type beta, for example, of Société Générale. Why not? Okay, I'm going on the website and you can see that here you have the beta. We look at the levered beta. Anyways, the unlevered beta has no meaningfulness for a bank. If you take 1 year period of observations, you have 1.81. 2 years, 1.85. 3 years, 1.67. And in fact, we do not have more because we do not pay, because all the information which is there is provided for free. But if I had registered on the website and paid some fees, I would have got 3 years, 5 years, 10 years, 20 years, 30 years, and so on. So I mean that according to the period and periodicity you choose, the outputs are different. It's the first point. I'm going to write it down immediately. I'm going to say possibility to fine-tune the beta, enabling to get the target value for the firm. You can do whatever you want because as the beta depends on the choice of the period of observations, 1 year, 2 years, and so on, and the periodicity. of observations. It's a great limit. I mean that everything is mathematically, technically done very, very seriously. But the problem is that when you want to use it practically, you can do whatever you want. This is the first limit. The second limit of the DCF approach, because there are other limits to say things seriously, is that we are dealing with expected free cash flows, forecasted free cash flows. So we can say that there is an uncertainty on the accuracy of forecasted free cash flow. It's the second limit. The third limit is that when you look at what's done here, okay, the equity which is there, which is there, or which is there, or which is there, is always the same one. I mean that the equity you are looking for is an amount which has to be taken into account in the WACC calculation, which means amazingly that you need the equity to calculate the WACC and you need the WACC to calculate the equity. It happens that Excel enables looping on itself to calculate this equity. Regarding equity, I do not have any issue. I have another issue beyond the beta, which is that here we have a debt. We have a debt, we have a debt, and we have a debt. Of course, it's the same one. But the problem is that if I am looping on the equity, it means that I want to have an economic value of equity. But I'm taking the book value of debt. So I'm going to say, and the very last point, inconsistency. To take the market value of equity thanks to a loop of the Excel model on itself. To take the market value of equity and the book value of net debt. And what I'm going to say that I'm going to have a break now because it's already 3 p.m. And just after the break, I will explain why Black-Scholes unable to surpass these limits and the way we need to proceed in order to see how the limits are surpassed. So I suggest us to have a 10 minutes break now before moving to the understanding of the usefulness of Black-Scholes. Okay? So I say 10 minutes. So we are going to go on. So I have explained just before having this break the limits of the customary DCM valuation approach. I'm going to show you firstly that if it was possible to value the equity of a firm based on the Black-Scholes formula, all the limits would disappear. This is what I'm going to explain now, and then I will explain why it is possible to have a look at the equity value as a call premium. I'm going to explain. So let's come back to what I was writing down. So I said three limits: the problem of the calculation of the beta, the problem of the calculation of the beta, which enters into the formula of the cost of equity, which enters in the calculation of the discount rate. So first issue, the discount rate. Second issue, the free cash flows. Third issue, the debt. So these are the limits. 3.1. 3.2. Refresher on the Black and Scholes formula. I remind you the formula is the following one. The call premium, I will define my notation in the coming seconds, of course, is S phi of D1 less E exponential of less R2 phi of D2 with, of course, here it is a call premium. But what I want to say that S is the spot price of the underlying asset, E is the strike price, R is the risk-free rate, tau is the time to expiration of the option. So here you have 1, 2, 3, 4, and there is a fifth parameter, which is sigma, which is the volatility of the underlying, I'm going to write it properly. Yes. So you might be a bit puzzled as I speak about sigma, because you can see sigma in the formula. Yes, but D1 is log of S over E plus R plus sigma square over 2 times tau, everything being divided by sigma squared root of tau, and D2 D1 less sigma squared root of 2. And if I want to look very clever, or just for fun, phi of x is 1 over squared root of 2 pi times the generalized integral from less infinity to x of exponential of t squared less t squared over 2 dt. Please don't think that you are going to calculate integrals, that you are going to primitivate functions. First of all, it's not a mathematics course. Moreover, there is no function, the derivative of which is exponential of minus t squared over 2, or with a change of variable exponential of minus u squared. So I mean that it's only numerical calculation. And nowadays, in 2022, we are no more going to read tables. We use the norm S dist function of x on Excel. I'm going to write more properly. Norm S dist of x. So I mean that we are going to prepare an Excel pricer for calls, and we can use it in any circumstance to value a call. So why am I mentioning the Black-Scholes formula? Because we are going to use it to value equity and to surpass the limits of the DCF approach. I mean that the discount rate we have in the Black-Scholes formula, the discount rate is R. It is a risk-free rate. Okay, it is the discount rate. And there is no possibility to discuss the risk-free rate, the discount rate. It is the T-bonds rate. So I mean that there is no possibility to fine-tune the risk-free rate. So I'm going to say it. No possibility to fine-tune the risk-free rate as it is directly read on the web, and it is the 10, not necessarily, the T-bonds rate. So this is the first limit which is surpassed. The second limit which has to be surpassed is relative to the difficulty to assess future free cash flows. And you can see that in the Black-Scholes formula, you have no forecast to be taken into account. Only a spot price and the volatility of the underlying asset. So it means that we can also surpass this second limit. The first one in red was the discount rate. The second one is the free cash flow. And I can tell you, and you have to trust me for 3 or 5 minutes, only possibility to apply the Black-Scholes formula to calculate the economic value of debt, which means that it seems to be possible to apply Black-Scholes and to get rid of all the limits that have been mentioned. But of course, the problem we have now, which will be solved in the 3.3 paragraph, okay, corresponds to the justification of the use of the Black-Scholes formula of the Black and Scholes formula to assess the equity value. I'm not going to do it immediately. I want to have firstly a pricer for any financial option, which will be turned into a pricer for real options. Let's do it. So I'm going to use a new sheet, or I can do it here. No, DDM valuation of a bank. So I'm going to create a new sheet. From scratch. And this new sheet will be options. So we do not need so many columns. We need 10 lines. We're going to say that we have S, E, R, tau, sigma, and D, and that's all. To have here tau and sigma. Symbol font will enable to have the Greek letters. Let's say that S is 120, E is 100. Here we have 1%. Here we have 0.25 year, and here you have 30%. Why not? And take whatever you want. These are assumptions in blue. So you can change whatever you want. So first point. The second point is that I'm going to enter D1, 1 being, of course, an index. Okay, then we will have D2. Then we will have a phi of D1, phi being the Greek letter corresponding to our F. And we will also have phi of D2. I forgot to put in 1 here as an index, and a phi of D2, which will be there. I need to build again my index, you see. And at the end of the day, there was a problem. The bracket is not as an index. And then I have the call frame I am currently looking for. So let's go. We said that D1 is numerator log of S over E plus R plus sigma squared, sigma times sigma over 2 times tau over sigma times squared root, so for me it is racine, of 2. So, R, sorry, it's not R, it is 1%. So you have 1.31. Okay, I can put the formula here so that it's more comfortable for you to see things that way. So I'm going to say that we have D1, luckily I'm used to typing that, is equal to log of S over E plus brackets R plus sigma squared over 2 times 2, everything being divided by sigma times square root of 2. So this is D1. Okay. And of course, I will also have D2. Which is D1 minus sigma square root of 2. So now you have the formula on Excel, because if you are not familiar with it, it's painful to follow. So D2, so you probably recognize, I'm going to put it on the left, but I'm sure that you've recognized the formula I have written down for D1. It seems to be 100% consistent. So D2 is equal to D1 minus sigma times the square root of 2. Phi of D1, I send norm dist. When I send to you later today the file, you will see inside the cell B1 norm dist, but in French it is loi normale standard, but you will see norm dist. Loi normale standard of D1, and to terminate, loi normale standard or norm dist of D2. And to terminate, I will use the formula for the call premium, which is C is equal to S times phi of D1 minus E exponential, or we can say exponential that way, minus R2 times the phi of D2 So now you have the required stuff to recognize the formula I'm going to use in the coming seconds. So say that we have S line times phi of D1 less E 100 times exponential of minus R2 R times 2 times phi of D2. And you can see that I have the code premium. And you can see that this amount can be broken into, of which intrinsic value and of which time premium. I think that we can put that here. So I would like to tell you that the intrinsic value has easily been seen. The right to pay 100 to get an asset. The market value is 120, is worth 20. The definition of the intrinsic value is the max of 0 and S less E. S less E. 120 minus 100, and unsurprisingly, we get 20. And at the end of the day, the time premium is the full price, 21.11 minus 20, and you get 1.11. Normally, you've already seen that in the first slide. This is the principle of Black-Scholes. This is a pricer for the Black-Scholes formula. So now I feel like saying, how can we apply this model to value equity? This is the point. So, I'm going to explain. I'm looking at the chat to see whether there are questions or not. It's okay. So, why can we say that we have an option? I'm going to explain with a simple example at the beginning, and at the end it will not be as simple because, as you can imagine, we will use the Black-Scholes. Well, let's imagine that we have a firm with a sole shareholder with a 100% shareholder of a firm, which is there. I'm going to write properly. A second. I'm saying that we have the shareholder with a 100% shareholder of the target. Why not? Of the firm, sorry. We are no more in the leverage buyout. This firm has an asset, 100. So, this firm has a building. I have to tell you that it's not possible for the shareholder, even if he is a 100% controlling shareholder, to get the building, to get any asset of the firm, for a simple reason, which is that the assets represent a kind of warranty, of guarantee, of collateral, you name it as you want, but it's always a warranty for the lenders. I mean that if the firm is going bankrupt, the firm has assets, it's always possible to sell the assets and to take the cash to repay partly the suppliers, the banks, more generally, the lenders. This is the point. So I'm going to write down, impossibility for the shareholder to get the firm's assets. To say, even if the shareholder is unique, and I also said that as the assets are or can be looked upon as collaterals. This is the point. Having said that, I have to say that shareholders have a limited liability, which means that if cash is required at the firm's level, they are not obliged to follow the capital increase. Let's imagine that we have a building, the value of which is 100, and we have a debt which is 20. Is it interesting for the shareholder to repay the debt? Good point. I need now to explain how it works. I feel like saying that the shareholders, as I've already said, can't get the assets because the assets represent a warranty. I would also like to say that from an economic point of view, not from a legal point of view. From a legal point of view, it's not possible. But from an economic point of view, it would be possible to get the assets assuming that lenders disappear. And the best way to get rid of lenders, without killing them, of course, is whether to repay them. This is the point. I'm going to write down that from an economic point of view, shareholders could get the firm's assets if they can get rid of the shareholder, the lenders, which means paying them off or repaying the debt. Repaying the debt. So, from an economic point of view, so could get the firm's asset if they can get rid of the lenders, but they are not obliged to do that. Thanks to the limited liability of shareholders, they will decide to repay the existing debt if and only if it worth doing it? Even if it is worth doing it, which means that the firm's assets value is higher than the book value of assets. So what I want to say is that the shareholders, at the end of the day, have the option to buy the assets. The strike price being the debt to be repaid, which means that the conclusion is that shareholders implicitly, and this is why we speak about real option, implicitly have a call on the firm's assets stock price value of the assets which is the enterprise value, the price. The strike price is the amount to be paid if you decide to exercise the option and you pay the debt. So debt to be repaid. Then we have R, which is always the risk-free rate. Unsurprising and unamazing when you deal with a bank. Tau is the time to expiration of loan, debt, and sigma is the volatility, more complex family, of the firm's assets. So we can say again that the equity is a call on the firm's assets. The underlying assets is the whole assets of the firm. The spot price is the market value of the assets, which is the enterprise value. The strike price is the debt to be repaid. Of course, we are going to come back to Excel. And I'm not sure you're still there. Yes, you are. It's a feeling to have done something wrong. I am not going to change the figures. I'm not going to change the formulas. I'm only going to say, let's change the names of the parameters. First parameter, spot price of the underlying asset. What can you buy if you exercise the option granted to the shareholders? You can buy all the assets, the enterprise values.
Professor, I don't see the screen.
You do not see the screen. Yes, I don't know what happened. Sorry. So I said that I'm not going to change the calculations. I'm not going to change any figure. I'm just saying that if I want to value equity based on the Black-Scholes formula, I'm going to say that the shareholders have a call on the firm's assets, which means that if they exercise their call, they get the firm's assets. So the spot price of the underlying asset is the market value of the firm's assets. And the value, the market value, the economic value of the firm's assets has a name. It is the enterprise value. Second point, what is the strike price? The strike price is the amount you pay when you exercise your option, your call. What can you get as a shareholder if you decide to exercise your option? You can get all the assets. And what do you need to do, in order to get all the assets? You need to get rid of the lenders. You need to repay the debt. So you have here the debt. Okay, the book value of debt. Book value of debt. Whereas here we had the enterprise value. So what do we have here? We have the risk-free rate, what it is. You have here the time to expiration, slight issue. Time to expiration, corresponding from a corporate finance point of view. So I'm going to say that it is a T-bonds rate, is a residual maturity. Debt. And here you have the volatility of the firm's assets. Underlying assets. Volatility. So that's it. So I mean that here, I will say that I have here the equity value. So this is the point. I have the equity value. If the enterprise value is 120, if the debt to be repaid is 100, if the risk rate is 1%, if the time to expiration, which means the residual maturity of debt is 3 months, 0.25 year, and if the volatility of the firm's assets, the volatility of the underlying asset is 30%, then the equity value is 21.11. Having said that, I have to say to you that it's possible, and this is what I'm going to do, to get the market value of debt thanks to the Black-Scholes formula. Here you have the equity value. Now we're going to have the debt value. Let's do it. I forgot to save. It's probably saved. And we're going to say that here, see, you have the justification of the use and so on. So 3.4 valuation of debt. Because I said that it was a limit. Why am I taking into account the market value of equity? And I'm taking at the same time, the book value of debt. We are going to see how it works. The proof takes 2 or 3 lines. So it's not very difficult. We know that the equity value is enterprise value plus the debt, where B is the market value of debt. So I will say that the value of debt is equity. Sorry. I'm tired. Enterprise value is equity plus debt. So it means that the bond's value, the debt's value, isolating that, is EV less equity. I'm sure that it's not an issue for you. But what is equity? Equity? Where is equity? I didn't write it again here. I would like to add as equity is S. Let's come back to the formula. We know that a call premium is S phi of D1 less E exponential of S R2 phi of D2. This is the basic formula you have in all books. We can say that the equity value is S spot price of the underlying asset is the enterprise value, the value of all the assets, times the phi of D1 less the strike price that you have to pay if you exercise the option, to pay the debt, exponential of less R2, phi of D2. So, well, we have here EV is equal to equity plus debt, so debt is EV less equity. And then I'm going to say that the market value of debt is EV minus S phi of D1, S being EV phi of D1, plus minus E exponential E, which is the debt to be paid, exponential of less R2 phi of D2. So we are going to have a slight change to get the right formula. Look, we're going to say that right, EV minus EV phi of D1, there's a D which is missing here, plus D exponential of SR2 phi of minus D2. Phi of D2, pas minus. Okay. You can see I've got rid of the bracket, the big bracket, so minus EV and lamb minus times minus is plus D exponential of less R2 times phi of D2. Of course, I can say that I have EV times 1 less phi of D1 plus D exponential of less R2 phi of D2. And I will terminate with the following formula. I have to tell you that 1 less phi of D1 is phi of less D1. So plus D exponential of less R2 phi of D2. This is what we will use on Excel after the break. But before having the break, I would like to tell you that this formula, the idea which consists in saying, well, let's value the equity based on the Black-Scholes formula, was proposed by Black and Scholes themselves. Okay. So we are going to have the break. I'm just going to check before having this break that you do not have questions. It's okay. Let's have the break now. I'm surprised not to see my camera. Just a second. Okay. So let's have the break now. So as you can see, we have a formula to value the debt. Please be careful. Here we have the book value of debt, the amount to be repaid, and here we have the book value, and here we have the economic value of debt. Let's put it in the model, and let's check there is no mistake. Let's put it in the model. So I'm going to try to show you the formula here, and to calculate on Excel here. Just a second. Normally it should work. So we're going to say that B, which will be the market value or the economic, the same, economic value debt. So let's see the formula. I'm trying to optimize the screen. Okay, so EV, a second. EV 120 times phi of minus D1, or 1 less phi of D1. 1 less, sorry, that 1 less phi of D1 plus D 100 exponential of less R 100 times 2 expiration times phi of D2 0.88. I don't think I need so many figures after the point. I will be very happy with 2 figures after the point. If I get to yes, I understand. So we have here the economic value of debt. I can also put a formula, as I did for the call. We can say that B is EV phi of minus D1, which is 1 less phi of D1, plus D exponential of less R2 phi of D2. It's the first point. The second point is that you could tell me, are we sure that it's correct, that there is no mistake? Personally, I feel comfortable because I can immediately see, based on what we've obtained, that here I could have put equity value here. This is well, we have it here, so it's okay. Equity value, we're going to put it here. Okay. So we can say that the market value of debt can also be obtained taking the enterprise value less the equity value. Is correct, as enterprise value is debt value plus equity value. So debt value is enterprise value minus equity value. So enterprise value on the very top, 120, minus the equity value, 21.11. And you can see that it is the same. You can see when I'm saying the two numbers are equal, when it's written down in French, vrai, it means that it is true. So we have now a way to calculate the market value or the economic value of debt. We have a model to have the equity value, the call premium, and with the formula, which is written down here, we have the market value of debt. Very last point I have to mention before moving to something else regarding real options. I mean that we can, thanks to options, I should say, thanks to Black-Scholes pricing model, we can calculate the probability of bankruptcy, which is an important point for a bank, because if the bank is seeing that the probability of bankruptcy is too high, it will refuse to grant a loan to the client. So it is probably one of the shortest paragraph, 3.5, probability of bankruptcy. Or we also say probability of default. 3.5, probability of bankruptcy. Well, I'm going to come back to something you've probably seen in another course dedicated to financial options, which is that phi of D2, and I do not have time to provide the evidence. You have to trust me on that point because it's not dedicated to real options. It's valid for financial options, is the probability to exercise the call. In fact, it is, to be very clear with you, the probability for the call to be in the money. The probability that it's worth exercising the call. So it's the probability to exercise the call. If we come back to corporate finance, if we come back to the firm, who is owning the call? The shareholders. Why would the shareholders exercise their call? To get the asset, to buy the assets, repaying for that the existing debt. The shareholders will accept to exercise the call, or we decide, I should say, to exercise the call if it's worth exercising it, if it's worth paying the debt or repaying the debt to get the assets. And it's worth doing that if the market value of assets is higher than the debt to be repaid. So I'm going to say from a corporate finance point of view, it is worth exercising the shareholders' call repaying the debt to get the firm's assets if the value of the firm's assets is higher than the debt to be repaid, which means enterprise value is higher than debt. It's interesting to pay the debt to get the assets if what you get can be sold at a higher price compared to what you've paid to redeem the debt. So I mean that if EV is higher than D, I can say exercise of the call by shareholders with a probability, which is probability to exercise the call, phi of D2. It is the first point. Now, second point. If EV is lower than D, no exercise of the call by the shareholders, we'll say, by shareholders, as, what does it mean? EV is lower than D. It means that the value of the assets is lower than the debt as the firm is going bankrupt. If the value of the assets, let's imagine that assets are worth 100 and debt is 150, not possible to just say economic values of the firm's assets doesn't enable to get the required cash to repay the debt. To repay the debt. So what I want to say is that if EV is lower than D, the firm is going bankrupt, so the shareholders do not get the assets. And the probability they do that, the probability they refuse to exercise the call, the probability not to exercise the call, with a probability not to exercise the call, I'm going to write properly, with a probability not to exercise the call, which is the probability of the contrary event, which is to exercise the call, which is 1 minus phi of D2, which means at the end of the day that the probability of bankruptcy is 1 minus phi of D2, and you can also say that it is phi of minus, I'm going to write properly, D2. So again, the probability of bankruptcy, the probability that the shareholders do not exercise their options because the firm is going bankrupt. They prefer to abandon the firm to its lenders thanks to their limited liability. Imagine nota instead of exercising their options, shareholders abandon the firm to its lenders, thanks to the limited liability of shareholders. So if we now wonder what the probability of bankruptcy of the firm we are dealing with is, we need one cell to calculate. We've said that the probability to exercise the option is phi of D2. The probability not to exercise the option because the firm is going bankrupt is phi of minus d2, but I'm not going to calculate phi of minus d2. I will calculate 1 minus phi of d2, which means, coming back to our model, that I can write down here 1. I have the problem I had yesterday. It's not possible to, don't know what happened. Again, 1, I don't know, I did something wrong. Let's see. Let's see if I can do it immediately. No, it's not possible. I don't know where I taped. So I'm going to have to do what I did yesterday. I'm exiting and coming back. It will take 2 minutes. Okay, so it seems to be okay. Sorry, but I know where the problem was coming from. It's okay. So the screen, no, it's not shared. Okay. Okay. So in fact, it was just for a very slight calculation. I mean that I want to have the probability of bankruptcy, bankruptcy. We've seen that it was phi of minus d2, or more simply 1 minus phi of d2, which is, I can also write it down, phi of d2. But you can see that I calculate phi of minus d2. Well, let's not put it here because 1 less phi of d2. Okay, 1 minus, I'm going to get to do it, 1 minus phi of d2. So you have phi of d2, yes, which has disappeared here, phi of d2. Okay, so it means that with the example, with the numerical example we took into account here, the probability to exercise the call, probability to exercise the call is 0.88, which means that the probability not to exercise the call, because the firm has gone bankrupt, is 1 less phi of d2, which means 1 less 0.88, which is 0.12, which means that there is a 12% probability for this firm to go bankrupt. So this is what I wanted to say regarding corporate finance issues in terms of equity valuation, debt valuation, and probability of bankruptcy. Now, to terminate, I would like to show you what a growth option is. We'll terminate on that. Growth options. Not very complex, but it's completely new and it's different from equity value. So this is the last point probably we will deal with together. So let's go again to OneNote. Okay, so we've seen here the probability of bankruptcy. So 3.6, which has no relationship with that, but it's still in the paragraph, which is dedicated to real options. This is why I'm naming it 3.6. 3.6. Here. Yeah. Okay. So 3.6. Seen many things. You look at that. 3.4, 3.5, and 3.6. Growth option. There is nothing to be explained in terms of formula or whatever. Everything has been said. Let's imagine that a firm contemplates the purchase of a 100% subsidiary in a small country, we are going to say in Uruguay, South America, for a consideration of, let's say 100 million euros. This firm has a DCF value which is the value of this firm. Let me try it differently. These firms DCF valuation is 90 million euros. Is it interesting to buy these firms? The answer is no. You are not going to pay 100 for a firm the value of which is 90. I mean that the net present value, I mean the sum of the forecasted cash flows, of the present values of the forecasted cash flows, minus the investment, namely 90 minus 100 is minus 10 million euros. So it means that normally you will refusal of the investment. But this acquisition, if it's performed, of course, would enable to test the South American market and to get an option to test the South American market. If the investment in Uruguay is profitable, the firm will buy another subsidiary in a bigger country, of course, in Brazil, in 3 years for a consideration of 1,000 million euros. The DCF valuation of the Brazilian entity, which has just been performed, is 900 million euros. Cash flows of the Brazilian entity are uncertain. Their volatility is 30%. The risk-free rate is, well, in Brazil, let's say 5%. Do you recommend to buy the firm in Uruguay? So we had the feeling that the answer has already been provided, because for the firm in Uruguay, we've seen that the net present value is -10. It's negative. So we say we exclude the transaction. But if you go in Uruguay, you test the South American market, and you have the possibility, if this test is positive, if this test is profitable, to invest in a new entity in Brazil in 3 years for 1,000 million euros, or 1 billion if you prefer. Again, you can say to me, but the net present value is negative. Yes, but today, you can't be sure that you will buy the Brazilians. Because today, when you look at the figures, say, I'm not going to pay 1,000 to get a subsidiary, the value of which is 900 million euros. But 900 million euros is the DCF valuation which has been performed today or yesterday. But we know that the cash flows, or the free cash flows, as you want, I can write down free cash flows, it's the same. Okay? The cash flows or the free cash flows of the Brazilian entity are uncertain, are volatile, which means that today the value is 900 million euros, and you say, I'm not going to pay 1,000 to get something, the market value of which is 900. Yes. But thanks to the volatility of the free cash flows of the Brazilian entity, and therefore thanks to the volatility of the DCF valuation of the Brazilian entity, it's possible that tomorrow, or in 1 month, or in 3 months, or in a year, the DCF valuation will be higher than 900 million. It's possible that next year, or in 2 years, or in 3 years, 900 million euros corresponding to the DCF valuation will become 1,100 or 1,200. And then you will decide to invest in Brazil, because you would say it's worth paying 1,000 to get an asset, which is a company, the market value of which, the DCF value of which is 1,000, 1,100 or 1,200. Which means at the end of the day that you have the possibility, in my case, to buy the subsidiary in Uruguay. I agree on a point, the net present value is negative, -10. But this acquisition in Uruguay provides an option to test the South American market, the option to buy the target in Brazil. So you have, if you go in Uruguay, if you buy the subsidiary which is incorporated in Uruguay, you have a call on the Brazilian entity. You know what you will pay if you invest. You know the strike price, which is 1,000 million euros. And there is an underlying asset. The underlying asset is what you can buy. It is a subsidiary. And the value of the subsidiary, the equity value of the subsidiary is volatile because it's based on a DCF, the free cash flow of which are volatile. And we have the advantage here to know their volatility. So in fact, the net present value of the deal in Uruguay is definitively -10 billion euros. You can see net present value -10. There is no discussion. I'm not around that. I'm not going to change anything. But it happens that we are going to calculate an adjusted net present value. I mean that we are going to add algebraically, of course, the negative amount of the net present value on the one hand, and on the other hand, the value of the call premium we have thanks to this investment in Uruguay. Because if we do not go to Uruguay, we do not have the option. We are not given implicitly the option to buy the subsidiary in Brazil. So what we are going to write down in order to solve the situation is that the investment in Uruguay enables to get the call to buy the Brazilian subsidiary in 3 years. Then the premium of such a call has to be added to the net present value in order to get an adjusted net present value. So what is the premium of the call? I remind you that for a call, we need S, E, R, tau, sigma. 1, 2, 3, 4, 5 parameters. What is the spot price of the underlying asset? What is uncertain? The spot price of the underlying asset. The spot price of the underlying asset is the value, the DCF value of equity today. DCF equity value as of today, which is, I would like to remind you, DCF 900 million. Strike price amount to be invested in Brazil. 1,000. And I should put a footnote assuming S is higher than E. R is the risk-free rate, 5%. Volatility, time to expiration, 3 years. Volatility, 30%. And based on that, we have the call premium. And I will say that the adjusted net present value, which is NPV plus C, is minus 10 plus, I don't know, we need to calculate. And the adjusted net present value will be, let's calculate it. This will be our last calculation. Let's do it immediately. So I'm going to put the assumptions here. And I'm going to open Excel here. So what I suggest is that we are going to say that this sheet is dedicated to equity and debt. And I'm going very simply to duplicate this sheet. I get to do it, which is another point. Let's duplicate. So move or copy. And we are going to speak here about growth option. Rename growth option. Okay. So I'm not interested in that. Can get rid of that. It's not very interesting to have that for what I want to do. Please don't worry, equity and debt isn't affected. We do not have to put that here. We can simply say that S is 900, E is 1000, R is 5%. Here we have 3 years, and volatility, I don't remember how much I took into account, 30%. 30%. So I do not need figures after the point. I can say that the call premium, I can get rid of the column, is 201. This is the call you have on the Brazilian subsidiary. So I'm going to say that I have the net present value of investment in Uruguay. We know that it is -10. I've already found that, -10. And then to terminate, I have the adjusted net present value. You don't need Excel to do that, but anyway, it is of course 191, which is what I was looking for. So it is 201. I'm going to write it down here and say that we have 201, and yes. So this is what I wanted to present to you today. So of course, as you can imagine, I'm going to upload that in the system, the calculations, what I also wrote down. I'm going to say that today, well, I can export it directly. I'm going maybe to say that it is, and it's already done, okay. To say that it is final. Okay. Yes, it's in OneDrive. Yes, I would have preferred to have it somewhere else, but anyway. Okay, so I'm going to put everything in the system. This is the first point. The second point is that, as you know, it's our last course. And unfortunately, when you have a course, you have to be graded. It's a case wherever you can go in the world. I don't think it's a specificity in France. So I have had a discussion with Alain Chevalier before starting the course today. He explained to me something I had already in mind, because what we discussed that, which is that we do not need to have a written test in a limited time. It will be a case you will prepare by a group of 4 people. So 4 is not 5, right? You can be 3 or 2. You can be 4, but not 5. Okay, it's a principle, because if I accept 5, I'm going to find students who will tell me we are 6. So it's 4. It's 4. I will send a memo on what you have to prepare tomorrow. Okay, I will. I didn't prepare it. It would take 15 minutes for me to write it down, of course, but I can't prepare it right now because I don't know the deadline. I don't know the deadline which is expected from me to give the grades. And once I know the deadline for me, I will say, well, I give them all the time except from today onwards, except the 3 last days. So I have time to put a grade. Okay, so I will probably have the answer tomorrow from Lynn. I have sent to her a mail, and Alain has also sent a mail where he has copied me. But anyway, you have time. Don't worry, you will have time to prepare. So I will provide a case in 2 questions. The first one will be dedicated to a bank's valuation based on the principle we've seen together. Okay, and the second point will be dedicated to the structuring of a leverage buyout. These are the 2 points. I will explain the formatting I am expecting. I can tell you, but it will be written down. It will be a set of slides, and you never send to a client or to a professor slides in PowerPoint format. You work on PowerPoint, but you send a PDF format. Okay. Personally, I uploaded slides in PowerPoint format so that you can use them if you want changing some points. But you will send a PDF. I will say the maximum and minimum number of pages. I mean that all the detailed assignments will be written down. Okay, and don't worry, I'm not going to send something to you tomorrow asking to have your work for Sunday night. No. You will have more time. Okay, I'm just waiting for the feedback of Lynn. Okay, so and for people. Are there questions before stopping? No question? Don't hesitate. I will also send slides regarding the EPS accretion you asked me to do today, of course, and of course the Excel model and so on. You have everything as usual with me. But no question? No? So if you have no question, we are going to stop here. If you have questions after that, the problem is that if you put questions in the chat, I'll not be aware and will not be aware of that. So the best thing is to send to Lynn, and she will by mail, and she will forward. I think it's the best way if you have questions. Okay, so we stop here. Okay for you? So let's stop and have a good evening and have a good night. And I will provide all the information for what you have to prepare by tomorrow. Bye-bye. Yeah, I can see as we speak French. I can't understand the slightest word in Vietnamese because I have a very good friend who is a colleague in another business school. The name of whom is Duc Nguyen. And I had a lunch with him several weeks ago, and a wife gave him a call, and it might have been important, so he answered. I couldn't understand one word, even one word. I mean that when I'm listening Italian, Spanish people speaking, I can understand some words. It's not very far from French. German, I understand. I've learned German at school. But Vietnamese, I said it to my friend Duc, impossible. Duc is his friend's name. In fact, it is Kung. Okay. So thank you, and please don't hesitate if you have some difficulties or questions to ask me. Thank you for your attempts to write in French. I can say it only in English because I can't answer in Vietnamese. I would have liked to, but it's not possible. Impossible. Okay, bye-bye.
You are currently the only person in this conference.